Good morning to those of you in the Americas. Good afternoon to those of you in the UK and Europe and Africa. And good evening to those of you perhaps in Asia. And welcome back to the Tinubu Conference Day. And for any new joiners, I'm Dipesh Patel, Editor-in-Chief at Trade Finance Global. Donald Trump. Say what you will about the man, but there's a lot to say. But he certainly makes sure there is not a dull moment in the industry and indeed the world. No doubt Trump will come up in your next dinner time conversation. So when the discussion turns to him, you'll be ready to jump in with, have you considered his impact on trade credit insurance? I'm delighted to welcome Harpreet Mann and her wonderful panel to now join the next part of the conversation. Harp and panel, please join. Over to you, Harpreet.
Thank you, Dipesh. Very pleased to be here today to join today's conference and to be accompanied by four great panelists. My name is Harpreet Mann. I'm president of Aminta Trade Credit Political Risk Solutions. And today our panel is going to focus on the U.S. credit insurance market and some of the economic and geopolitical events that are going to potentially impact our credit insurance market in the United States. I apologize that I'm not going to be on camera, but the other panelists are, so it'll work out well. I will turn it over to the panelists to quickly introduce themselves. So, Serena.
Hello, everyone. Thanks, Harpreet. My name is Sarina Puccio. I'm the head of the credit and surety team here in the US in Princeton, New Jersey. I have always worked in the trade credit and surety space, so I'm super excited to be here today and discuss that involving topic with you all. And it's not just an insurance topic, it impacts reinsurers and industries. So as Dipesh said, we have a lot to talk about. Thank you, Harpreet.
James?
Everyone, hi, good morning, everyone. I'm James Daly. I'm the president of Allianz Trade here in the Americas. Looking forward to the conversation.
Maximilian?
Hi, everybody. Thank you for joining us today. I'm Maximilian. Max, please call me Hess. I'm the founder of Enmatena Advisory, a London-based political risk firm specializing in advising the trade credit, insurance, and hedge fund industries. I am also a fellow at the Foreign Policy Research Institute back in the United States, where my accent obviously gives away that I'm from, and a fellow at the International Institute for Strategic Studies here in London.
Antoine?
Hello everybody, Antoine Meglet. I'm VP Go-to-Market at Tinubu. I've been working for 20 years in the tech industry for financial services. I worked at Microsoft, Scale-Up, McKinsey Consulting, and I've helped many financial companies grow, scale, optimize their business in, I would say, in complex, uncertain, and disruptive contexts. So happy to be here with you and with such good panelists.
Thank you. So one of the first topic is going to be around the U.S. credit insurance market. And while we've seen it grow slightly, it's not grown at the pace that we would all like. And so, James, can you give some of the challenges that the market is facing as to why perhaps the market hasn't grown over the past few years, but also some of what the industry is doing to try to expand the market?
Sure, great question. Yeah, so just as a little quick history lesson, the credit insurance, the modern credit insurance as we know it, was born in America many years ago when the railroads started to cross across the country. However, when you look at the penetration, i.e. the number of companies that could buy trade credit insurance that do, US is still the smallest, the least penetrated market in the US, in the world. The premiums in the US market in trade credit are around $1 billion. And as you say, Harpreet, they've gone slowly up towards that 1 billion, and I saw this going up to 1.1, maybe down to 900 over the last couple of years. So we're not seeing, as you say, tremendous growth. So when you look at that conundrum, why is the US not growing at the pace you see in other European markets, for example? And to me, the puzzle has always been here for us here at Allianz Trade. You know, we have a direct business that we go and try and search out for opportunities, and it really is evangelizing what we do, what trade credit is, because when you look at those dynamics, 1 billion a premium, that's delivered by 20,000 US companies into our marketplace. In our database, there's around 18 million companies that could buy trade credit, i.e. they're selling on credit terms, and there's they're of a size that's interesting to a credit insurance company. So when you look at that dynamics, there's nearly 20 million companies that could buy it and only 20,000 that do. You've got to sort of examine why that is. And to me, it's first of all, it's an education. It's as I say, the evangelism that we do to try and promote the product out there, because we have to do that on ourselves. Because government bodies or even education bodies, if you do your CPA exams, you're probably not going to have a chapter on credit insurance. Whereas in Europe, I think it's slightly different. There's more education around how to use the product, how to use credit mitigants. You also have the culture in the US. It's far more risk taking than you see in Europe anyway. The CFOs, the credit managers have a higher tolerance to risk. And also the understanding banks have of trade credit in the US is not at the same level that you have in Europe. So the banks aren't endorsing or pushing the trade credit solutions for their clients as they do in Europe. And also the bank as a customer in the US, it's challenging for us because some of the regulation exists means that we can't actually execute some of the products that can be executed in Europe, for example. So a lot of that premium actually offshores. So there's, when you go to the nuts and bolts, how do you grow the trade credit market in the US? It's creating awareness. I think we all try and do that every day. Conferences like this are tremendous in that effort. But to me, the nuts and bolts is distribution. How do we get our product in front of people? Because people don't wake up thinking, today I want to talk about or buy some trade credit insurance for my business. They have to be taught, introduced to it, and people have to get an understanding of how it can add value to their business. So, sorry, a quick overview there, Harpreet. Hopefully, some of the panelists have got some other comments as well.
Yeah, I think one area that we've been working on as an industry is you touched upon is with the banks, and we're not able to, because of regulatory interpretation, cover all of the transactions for banks that carriers can in Europe. And additionally, U.S. banks can't get capital relief in the same way that European banks can. And so that's been, I think, one of the areas that you've shown a lot of leadership in supporting those two initiatives. If you want to talk a little bit about, the goal there is to expand the credit insurance market in the United States for banks specifically, and potentially create greater awareness of the product.
Yeah, I won't. You've been very kind with your kudos there. It's you who are really leading that charge, I would say, Harpreet. I think we're just lending our weight because we're a very interested party in the outcomes. But we've clearly had our legal teams and the industry's legal teams working on having conversations with the regulators, because we believe we're being caught by a regulation that wasn't designed to prevent us to do what other markets do. So the industry, as you say, is lobbying, going in, showing the New York regulator how this is of interest to the state, to the companies registered in that state to be using US-born solutions rather than having to go offshore where they won't be collecting any tax revenue, for example, as the state insurance regulator. So that the industry is making all those efforts to help, but it's the energy required is intense. So anyone that can think of how they could help that cause will be welcome, or the conversation on how we can open more ears to the conversation would also be welcome. But I think the efforts we're doing right now are tremendous, as you say, Harpreet. But it's a slow beast to work with. So hopefully we get some positive dialogue in the next few months or so. But I still believe we've got some work in front of us on that topic.
Definitely requires a lot of patience. I can say that much. Serena, from your perspective as a reinsurer, and you hear about these potential, these opportunities to grow the credit insurance market, what are your thoughts?
Thank you, Harp. I would agree what James just said and wanted to highlight a few more of his points. Like we also, as a reinsurer, we have to help to advocate for the product and participate in these panelists like we're doing today, or participate in advocacy, writing those papers and getting the word out to banks, etc. So reinsurance really plays a very strategic role. And I think in particular in those times where we are right now, in these uncertain times here in the US, nobody knows what is really going to happen. And hopefully that creates also that awareness of companies, hey, maybe I should explore trade credit insurance and go that route. And then of course we need to provide the capacity that the primary companies can provide those limits and maybe more limits going forward. So we also help, or I see us as a catalyst also for innovation. Products need to be modified going forward. So that's why I think it's good to have the reinsurance also as a partnership. And last but not least, I would say we also have a lot of expertise and knowledge, a lot of data within our company. So I think that's something we also provide to our companies and our cedents to improve underwriting and pricing as well. Thanks, Harp.
Thanks for that, Serena. Anton, as a technology provider for the U.S. credit insurance market, what are your thoughts on, some of what you provide and how it can help grow this industry?
Oh, that's a great question. I think I'd like to start maybe by talking about claim management, because I think it's a key piece of the puzzle to, I would say, to scale the size of the market in the US. What we have seen in many markets is that when you have effective claim management, you build confidence on the market, and it's a catalyzer to grow the market. It's not the only one, obviously, but it's an important one. And claim is always tied to economic cycles, policy shifts. And what we are looking at right now is in the US, that with the new US admin, very likely it will continue to introduce impact on tariffs, tax changes, and so on. And by consequence, like we saw during the COVID or the inflation, very likely you might have some default, mostly for companies exporting outside of the US and so on. And there is a key point for which insurers need to mitigate risk, right? On that. And answering your question, you have two possibilities to mitigate risk. Either you have the traditional way or the technological way, which both are complementary. The traditional way that insurers will use is to improve the portfolio quality by reducing the exposure to lower quality risk or vulnerable sectors, diversification. But we are seeing new strategies, and probably it will apply in the US, I say probably, is to leverage data and AI. Data for enhancing real-time monitoring, leveraging alternative credit data, implementing dynamic pricing to adapt to the shifting trade conditions. And what we see also is the use of AI popping up to help forecast, I would say, claim surges by analyzing trade policies, financial stresses, geopolitical risk, and allowing, I would say, carriers and insurers to adjust their coverage proactively. And this is clearly where tech can be a catalyzer and accelerator of this market, as an example.
Thank you, Antoine. We're going to shift gears now to the U.S. economy, and U.S. economy has been incredibly resilient, but it was a key factor in the election outcome. And Serena, as we look at give the U.S. while the U.S. economy has been resilient, there are some challenges. If you can speak a little bit about your thoughts on the U.S. economy.
Yes, sure. Thanks, Harp. Yeah, overall, I think you're right. The US economy has been proven to be very, very resilient. Just to point out a few key factors. The US economy is projected to grow at an annual rate this year between 1.9% and 2.5%. So this is from various economists like Vanguard and Goldman Sachs. So this is really, really good. And they came off from a very, very good growth perspective last year. So these are all good signs also for hopefully to get more awareness and to increase trade credit insurance in the US. Then I would point out there's a very strong consumer spending in the US, which is obviously a significant driver for growth here in the United States as well. The unemployment rate has been low for a long time, around 4%. This is another very, very good sign. And then last but not least, inflation. I think we're not there yet where we wanted to be, but we have achieved a lot and it came down. So I think the class is really half full and not half empty, I would say, Harp.
And James, from your perspective, what are your thoughts on the economy? US
Yeah,
economy.
so one, inflation's still with us. It's not gone away, and also it's compounding inflation. It's not, so people forget it's every year it's 3% on 3%. The tariff and the immigration policies will, although it's still not clear what they are going to be, they will have inflationary effects. We're sure about that. If there is a full-blown trade war, what you've seen over the last couple of days with in-out on trade levies, it's but if there is a full-blown trade war, that will damage, in our view, the U.S. economy. So passing a budget's going to be chaotic in the US. This first budget is going to be entertaining from the outside for sure. Like Serena said, we believe the economy is stable. It's the growth in the same range as predicted. So we believe there's an argument, not a strong one, but there's an argument for one more cut from the Fed this year. But the Fed is on a tightrope right now. It's basically it's got persistent inflation and the economy is cooling. So it's how the timing of another cut is going to be critical. We in our own business, we're starting to see claims increase dramatically. So the frequency claims are definitely back into the system, and they're increasing at a level that we haven't seen since before COVID. So since during COVID. So it's definitely as an early bellwether for us, and we're starting to see in our own measurement the confidence index with our clients, with our purchasing managers, they're all dropping, predicting contraction, and also the shift in credit card debt that you've noticed, if you've noticed year on year, is worrisome as well.
Claim side, are you seeing an increase in insolvencies, or are these more defaults?
So we are seeing an increase in insolvencies for sure. Most of our claims, as you may know, Harpreet, as we take the whole turnover, are primarily what we would call protracted default. There is no official filing. It's gone away businesses predominantly.
And Serena, from the reinsurer side, are you also seeing an uptick? Because I know it's been a pretty benign market over the past few years, even though there have been people predicting recession for years now. What have you seen from the reinsurer side on claims?
Yeah, we just came off the 1/1 renewals, and so far I can just say it was a very orderly renewal. Despite the fact what James just said, there has been some increased loss activity. It hasn't really material trickled through the reinsurance treaties. Quite the contrary. You've seen more players on the reinsurance side who want to participate in the trade credit and political risk in the surety space. But also to James' point with more, we're also hearing that there are more insolvencies, but not across the board, but in certain sectors like manufacturing is one, retail. But it's more like hopefully this year, 2025, will more be like a year of stabilization. Let's see, but still the insolvencies are high.
Thank you for that. Antoine, as we were just talking about, some of the challenges in the U.S. market in terms of, economic indicators, what are some tools that can help? Like, for example, the advancements in technology like AI. How can we leverage that?
I think there are two. My answer would be twofold. On AI, we all saw the push from Trump on AI with the huge investment. I would like to raise the attention on a paper published by Bank of America on the concept of agentic AI. Probably some of you read that paper. The idea in the financial services, and more specifically in the insurance sector, is that the path is going towards the full automation of the value chain, from submission to policy insurance. I could develop and elaborate a bit more on that, but the idea is to build and scale insurance business with, I would say, very low operating cost, and at the same time engage faster with new digital experiences with the brokers, with the prospects, with the insured, through portals, through bots, through new conversation. And all the conversation that we have with our customers and prospects, we saw that engaging in a new way with AI, with bot and so on becomes a differentiator on the market and a path to expand and to capture more business. The second part of my answer would be more data oriented. I think on the market there is a key word which is unpredictability. I mean, it's not only about climate, fires, inflation. I mean, there are so many potential disruptions that are coming. And so it's pretty hard to predict what's going to come and to build the confidence. And what we see in many industries, and what's going to happen very likely in our industry, is that is the building of what we call data-driven ecosystem, in which all the actors cooperate to share in a system, in a source of truth, fresh, immediate data to build confidence and to be able to anticipate and to forecast a little bit the future. And this is basically what Maersk did with Microsoft. They built a data-driven ecosystem with Microsoft with real-time data to modulate in real time their risk to adapt to any kind of disruption. So AI and data are the two enablers.
Thank you. Max, one of the, as credit insurers, we monitor geopolitical events, and James touched upon tariffs. And we saw over the last week a lot of activity around the tariffs being imposed on Mexico and Canada, and specifically. And while they've been paused, today there's news that China is threatening to, or they might have already started investigations into Google and NVIDIA, and now are further saying they're potentially looking into Intel. Could you speak to a little bit about the geopolitical climate at this time?
Sure. I would just add that Apple has now also come under China's targets for this. And, I think we're really seeing a very large shift in areas of geopolitical risk, particularly as they affect trade credit markets and the broader class of credit and political risk business, which is rather than looking at major conflicts and the areas that they can drive risk, that has been such a key source of market developments in the last few years, whether that be the energy crisis that came out of the Russian invasion of Ukraine in 2022, the disruption to trade through the Red Sea, and fears for significant escalations and volatility in the energy markets that we saw in the aftermath of the 7th of October and the wider conflict in the Middle East, to now the U.S. really taking a very different position than it took even under the first Trump term, and with Trump being far more willing to use a far wider and broader variety of tools. So we saw this both with the threatened tariffs against Mexico and Canada, but also against Colombia just 10 days ago now, or 11 days ago now. news cycles in the Trumpian world can be very short. It's also been that long since we've heard about Greenland. But he's cited the International Emergency Economic Powers Act, IEEPA, which is a 1970s era legislation that does give the president significant authority without the ability for real legal challenges from it, so long as there's something that Trump can hang his hat on in front of the courts to push these through. So is fentanyl and human trafficking via Canada actually a serious issue? No, it is not. Does that justification allow for tariffs to be used, and the courts can't really or very easily go to any precedent to overturn the president's determination on national security assumptions? No, they cannot. We also saw, with that Colombia case in particular, the threat of financial sanctions, the kind that are traditionally reserved for Russia, Iran, North Korea, countries that are actively opposed to U.S. geopolitical interests and on the opposing side of conflicts in various areas, whereas Colombia is not only historically one of the U.S.'s closest allies in Latin America, but also the largest recipient in South America of U.S. military assistance for the fight against illegal narcotics and against the left-wing militia group that still remains active, the ELN, and splinters from the FARC. So Trump being willing to use these threats raises whole new questions, because some of the financial services sanctions that would be threatened mean not only would coffee be more expensive, but certain kinds of insurance products, as well as trade credit products, even before they come to the insurance stage, couldn't even be written in those countries were Trump to enact those threats. Now, 11 days is a long time in Trump world. Things can move very fast. This is a intentional policy, as we saw J.D. Vance, the vice president, explain in an interview yesterday. But in terms of thinking about these things sort of more broadly, I think we also have to look back to a world that is maybe even pre-1980s to try to determine and understand some of these levels of risk. So leaving anyone's or even my own political opinions aside, right? I think we do need to understand that there is potentially some kind of a method to the madness, so to speak. Trump does have real goals. Some of this has been referred to. I'd point you towards a very good Financial Times piece called the Mar-a-Lago Accords, updating the fundamental underlying agreements of the international political economy that came out of the post-Bretton Woods era after the U.S. left that in 1971. In the 1980s, what were the Plaza and Louvre Accords? The Mar-a-Lago Accords is the name of the FT piece and the idea for this new thing. But essentially what this means is that the Trump administration is looking for a weaker dollar, which the higher interest rates, the differential between U.S. and European rates is going way up, and you can see that in the yield curves already, is very difficult to achieve. So you want a weaker dollar, but Trump is also very strong and very adamant about keeping the U.S. T-bills as the global reserve asset and currency. And of course, demand for U.S. T-bills is normally strong for the U.S. dollar. So you really need some kind of negotiated agreement between not just Treasury and finance ministries around the world, but central banks. Now, in Japan, the Plaza and the Louvre Accords and the aftermath of them are seen horribly as something that really led to the lost decades of the 1990s and 2000s by essentially at the time raising the value of the Japanese yen significantly and weakening its export base. Today, the country that these negotiations primarily have to be held with because of its size in the global economy and its position as the largest holder of Treasury bills is, of course, China, with which Trump does not exactly plan on taking a friendly or low-key approach. So getting there and negotiating that kind of an agreement is actually, in my view, what the Trump administration kind of has in mind. But there's going to be a lot of shadow boxing, a lot of threats, and a lot of potentially really serious short-term disruptions in an attempt to get there. And then in the attempt to get there, there's also no guarantee that it will be successful. So, thinking about those things through, both in terms of short-term trade credit and some of the medium-term products, is going to be really, really important for underwriters, and I think is really going to drive demand for the product from consumers and banks in the United States.
Thank you. You hit on a good point about some of the reasons that Trump is pushing, like, for example, the tariffs. Behind it, in the White House official statement on the tariffs, there was focus on fentanyl and trying to we have a serious fentanyl problem in this country, and that was what, allegedly these tariffs were aiming to control. Similarly, when you look at the Panama Canal, right, and you've heard Trump say, "Oh, I'm going to take over the Panama Canal," can you speak to what's behind that?
Sure. So the Panama Canal has faced significant disruption due to El Nino and La Nina weather patterns in the last few years, causing lower water levels. Rates have gone up quite significantly. The rates for ships going through the canal went up just in January by as much as 20%. And while it is true that Panama does have links to China's Belt and Road program, it has been far less supportive of that than a number of other Latin American countries. Peru, for example, which has come in for even larger threats, even if they haven't made it through the news quite as much, from Mauricio Calderon, who is Trump's Latin American special advisor and was previously the head of the Inter-American Development Bank, so certainly somebody who's familiar with the product and the industry. And he called for specific tariffs on transshipments through those ports in Peru that China is building. As for what Trump really hopes to achieve with Panama, it is also notable that the Panamanian government that was elected last year is nominally a center-right government, and historically would be more aligned with a Republican administration in Washington. And we're really seeing big changes to those kind of historic linkages and tie-ups, not only across Latin America, but across the world. One area that's come under particular attention from the Trump administration are investments in two port handling facilities on the Panama Canal by Hong Kong's Hutchison Group, Hutchison Whampoa previously, also the owner of major telecoms infrastructure around the world. One that actually had historically not been seen as close to China. And on the other hand, the ports in Peru, for example, are being developed directly by Chinese state-owned companies. So the breadth of sort of that level that Trump is really willing to go for in terms of fighting Chinese perceived Chinese influence in the Americas is going to be significantly larger than it was in the first administration. Do I think it's necessarily likely that Trump is actually serious about wanting to land troops in the Panama Canal? No, but Panama does not have a significant standing army. It is also entirely dependent on the US dollar. It is a key banking center for Latin America, even if it's lost out to the attractiveness of Miami a little bit in recent years. So it essentially is one where Trump can go in and try to make the kind of concessions, try to force through the kind of concessions that he wants, and claim an early victory on these issues that we are going to see play out over a much longer horizon, months at least rather than weeks, elsewhere in Latin America, in Peru, Brazil, a number of other major economies. But I think one area where we will see a key difference is there will be preferential terms for U.S. shipping coming through the canal compared to other ships.
Thanks. James, on the tariffs question, the discussion around tariffs, I've heard a bank client say that they're going to potentially see decrease in trade, and therefore it could impact our industry in terms of demand. What are some of your concerns or thoughts?
Yeah, I think first of all, it's still very unclear what the complete tariff setup's going to be going forward. So what we're doing with our clients, like you say, people are coming in and asking, how can we assist? How can we help them look forward? So we're basically putting together the plans with our clients to analyze their exposure to trade that may be tariffed in the future. So we're giving up common sense advice. So they come to our clients. They should be looking at diversifying their supply chains, looking to source from tariff-free regions if they can. Pass on those costs those costs are coming. We had them the last time. They were able to pass on some of those goods because the cost on those goods last time because the demand was so high. So if you think we had clients in the semiconductor space, they were able to pass on those tariff charges in the past quite easily. But going forward, I think they need to think about how they pass those costs on without driving customers away. Every company's now got to look at can we improve our operational costs, because if the tariff's going to come in, it's going to affect my margin, it's going to affect my operating margin. So I've got to maybe look at better ways of doing that. Using tech as AI as inside your organization is an obvious place to look. Leverage on trade agreements and tariff exemption zones that exist. Go and discover them, find them. Adjust your product sourcing where you are maybe outsourcing manufacturing. Start to plan this, think about it, what ifs. And also we're also advising our clients to, particularly as Max said, to start looking at their currency hedging, because the fluctuation in currency we predict is going to be rocky in this transition.
Thanks. There's actually a few questions, and one of them just hit on AI, which is a big topic for all of us. The question is, we've seen quite a lot of chat about AI and credit risk assessment. Could you elaborate on how exactly you're using machine learning to predict defaults? Are the results proving more reliable than traditional methods?
I can take it, Harpreet, if you want.
Sure.
I would say that AI in risk assessment enhances prediction accuracy by analyzing vast data sources, including financial statements, behavioral patterns, or alternative data. If you think about machine learning, for instance, it helps identifying hidden signals. It helps continuously updating the risk scores in real time. And if you compare it to traditional methods, AI offers, and this is what we see with some of our customers, they are using AI and so on, it offers higher predictive power, early warning detection, and better risk differentiation while adapting to market changes. There is a caveat, though. We need to be super careful with the usage of AI. There are some challenges regarding bias, regulatory compliance, and one point which is super important, and we call it the model explainability, the capacity to explain how AI makes a decision or proposes a decision. Those are the main concerns. And so what we see is the implementation of what we call hybrid models, in which we combine AI insights as a copilot with traditional risk frameworks for better reliability and transparency.
Okay, thank you. On the claims end for AI, James and Serena, have you at all thought about how AI could be leveraged on the claims side or on the credit risk side yourselves?
Yeah, on the claim side, we've got an interesting case study. So we now it's more on the technology post-claim. So I'd love some AI that could prevent me having a claim before it becomes a claim. But right now we're looking at when we have a claim, one, is that claim valid? So you can use some of the AI technology to look at any fraudulent activity that may be occurring. And then what we then with our customers, we can score the propensity for us to make a collection on that debt. So we can grade it, and so we can put it to high priority, high chance of collecting some of the debt, recovering some of the debt, or low priority, and then you can organize your activity more efficiently against that. So we've seen that on the claim side. On the credit risk side, we've been using machine learning for many years. I think 80% of our decisions are automated, but that's a machine algorithmic process. But we have a set of data scientists now who are collecting all of those auto scorings and doing the regression to see how accurate they were in case of a claim, in case of some other information that we hadn't identified, and training the algorithms now to understand how we can score the credit quality in the future. So that's and the information sources we can drag in now are very different. As Antoine said, we can capture behavioral data, perhaps, which we didn't see. You can see review data. If a certain business keeps getting 1-star reviews, it may be an indication that something might be happening there. So all of that data that's out there open, we can, AI can efficiently interrogate. So and we can learn from that. So it's quite exciting. We're not at the point yet, Antoine, of allowing AI to make a final decision. It's just part of the get to the decision.
Yeah, I was in front of an insurance company yesterday who was saying it's possible that, I'm just going back to the claims point, that AI could become a big part of the claims analysis and make it quicker, more efficient. And so, Serena, I don't know if you have any thoughts on that.
It was very similar what James said. At the moment, it's very like post. You want to analyze certain claims and to see some trends, but ideally you want to predict what can you do to avoid claims, right? Given the amount of data, what is out there. I think we're on a good path, but we're not quite there yet.
Thank you. There's another question, and this is shifting gears. With all this talk about domestic production, do you think we'll see specialist credit insurance products emerging for reshored manufacturing operations?
Don't they already
James?
exist? I would say, don't we already have coverage for that? I would guess.
Think so. Think
Yeah.
so.
Speak to your insurance broker.
Yeah, you need the insurance broker. But I do think our industry is pretty good at developing products. Over the, I would say 10, 15 years, I've seen the industry respond to the needs of customers. So if there is something unique or it's a service, we've become more adept at being able to cover those different transactions. And here's another question. What is your experience of increased demand from brokers and other third-party stakeholders for API, application programming interface, integration to your underwriting systems? How can it support your service offering? So I guess, Antoine, that's for you. And James.
I can start, yes. Like I said in previously a few minutes ago, what we see more globally is that the way brokers, insurers engage from a digital perspective with their prospect, their customers, becomes a differentiator. Clearly, it's about speed, the time in between the submission to the policy insurance, but as well in terms of, I would say, quality of experience for the users. And so there are new channels popping up. We all know the, I would say, portals. There is a current modernization on the portals, web portals used by the brokers and the insurers. But what we see, and this goes back to your question, is the emergence of new way of conversing with your prospect and brokers through emails, through bots. And this is where API becomes super important, because it's somehow the plumbing, but the modern plumbing to, I would say, to communicate with your IT platform and to choose, I would say, the way to interact with your prospect, customers, brokers, and so on. And you can decide whether you want to have a conversation through emails, through portal, through chatbot, and so on. And API is the core capability to enable that.
James, I mean, the APIs have been important for the underwriters in terms of, and for us, frankly, in reporting in terms of data integrity, tying straight up, for example, to DNB and knowing that the buyer that you have in the system is you have the right names, et cetera. Can you talk a little bit about your thoughts on what Antoine said?
Yes, I mean, we've been, I think we were right there at the genesis of API technology before it was probably called API technology. It was, I thought maybe Antoine will remember what it's called, but we've always had some sort of plumbing between us and our clients historically. But as the world evolved, we set up basically a digital team globally, And over those years, they built an API catalog. And any of our clients or prospects or brokers can come in into the sandbox and for no, just come in like tech company, come in and play around, see if it will work, connect. And ultimately, we start to refine that catalog into plug and play APIs for clients who don't want any IT interface. Because some of the challenge for a lot of the APIs is the client or the broker is going to have to do some work on their side, unless they've got some generic systems that we can plug into. So like Tinubu. It's becoming more and more of the normal conversation now. So we have a dedicated team, as I say, in the US, who are working with our clients on digital integration, and it works from looking at how they simply work with us in managing the policy, or how they might want to manage their account receivables, do some analysis on it, score it, or they might want to check, certain countries, whether what information we have in there, what we might, they might want to run a sales, an opportunity, what do you call it, prospect ledger through an API and score it before they actually go prospecting. So all of these APIs are available within a library now, and it's just becoming a normal way of working with our customers, with our brokers. And it will continue to be so.
We have another question around claims and about the different claims patterns between domestic American trade and international trade. Do you see a difference there, James?
Yeah, so something's happened to my device. I'm back.
Yep, we can hear you.
Yeah, so generally speaking, our premium is allocated by domestic and export exposure, and that's split approximately is 80-20. So 80% of the premium we're collecting is for domestic exposure, and the other is export. A lot of that export exposure, as you'll know, Harpreet, is bank driven. So it's within a factoring policy traditionally. A lot of US exporters don't insure directly. They may be doing it through a bank policy. So when you look at that, if you just wanted to do a rule of thumb, that the banks are by nature are very strong at managing their own credit, and then we're coming up beneath with a wrap for their invoice finance business or export invoice finance business, for example. So generally speaking, the claims experience in there is low because the quality of risk is high. Then generally, when we move over to our domestic business, that's across all trade sectors, that's across all size of companies, from a $5 million company to a $5 billion company. They're in there, so you tend to see that you get a normal distribution, and so the claims ratio is going to be at our normal levels, and our domestic level, I would say, be 20 points probably below the normal level. So. So that the moral of the story is we need more export exposure being insured by the insurance companies in the US.
One question is around fraud. Our policies are not, we're covering credit risk, but there's times when there have been frauds committed with and we end up covering it even though, and because a policyholder has no part in it. I know, Serena, if you want to address, some of your thoughts around perhaps some of the larger claims you may have seen that result from fraud, and your thoughts around that.
Harp, I would like to, but as I said, the claims activity has been very, very low. Maybe that's something James can better address in a fraud, from a fraud perspective. I have not come across this at least recently.
Yeah. So, Harpreet, just to be clear, the credit insurance policy doesn't cover fraud, generally speaking.
Yeah.
But what you're saying is that we're getting claims because of our you know,
Yeah, there
because
have
of
been some big ones. Yeah.
yeah, there's been some frauds in or bad accounting or poor whatever's. You know, we all Americanas was not a fraud. It was just down in Brazil. It was a, you know, a misjudgment in accounting. So it's, which is still bad. So you know, I would say I would say there has been some well-known large cases, but I would say overall the majority of the claims that we paying out on a regular basis are for non-fraud reasons. I would say it's a very small proportion, but when it comes, it's well known and people hear about it. And generally speaking, you know, they are drawn out claims situations as well because of the complexity of it all. So that's why you tend to see some of these names, these fraud cases, well talked about, whereas in our general run-of-the-day business, you know, it doesn't represent very much at all.
Well, we're coming up. I don't. We're coming up towards the end of our time, and I hope that the attendees got a broad overview of the credit insurance market. And even though it hasn't grown as much as we want, we're still positive on the industry, and that the U.S. economy and geopolitical discussion that we had. Even though there's challenges, I think our industry is used to underwriting in challenging circumstances. But I wanted to give each of the panelists, if you want to make any closing remarks. So we'll start with Max.
Sure. Thank you all so much for joining us today. You know, what I think I would like to close on is to say risk is ever changing, as we said at the beginning of my comments. The questions that we look at in helping clients navigate some of the immediate issues in the short term today are not necessarily the same ones that were asked 2 years ago, 3 years, or 4 years ago. I've had the good pleasure of working with people in the credit and political risk insurance industry for the last 14 years. And for those who are looking to learn more about the product or to use more about the product, I can say that I have, you know, always really encountered particularly excellent understanding of people's business models and how to mitigate risk through the use of the product from the underwriters in the class of business. And, you know, trade credit insurers are here to help you and here to help you grow, because that is mutually beneficial for them, and in turn also beneficial for me and our firm. So I'm sure the industry will continue to grow well, and please do feel free to reach out to me if there's any way that we can be of assistance to you.
Thank you. Serena?
Yeah, I would agree with Max. Let's use this as a wake-up call, so to speak, that hopefully the tariffs will not come into play. And you saw already Trump used this as a negotiation tactic. Otherwise, he would not have paused it for 30 days. But clearly, it's a heightened risk environment out there. You heard all the reasons we outlined, that companies should think about, inform yourself about trade credit insurance, and it could be really beneficial going forward in that environment, because it's highly fragmented and those bilateral agreements become more important.
Antoine?
Sorry for my mic. Yeah, just a simple word. I think the key word for me, from my perspective, is unpredictability. And what I've seen in many industries, what I was at McKinsey and at Microsoft, is that in such context, I would say that co-petition might be the solution to that. By co-petition, I mean it's a mix in between competition in between the players and cooperations to face the risk and the complexity. And I share some examples through AI and data-driven ecosystem, how key players can cooperate to reduce the risk and to seize opportunities.
And James, of course.
Thank you, everyone, for joining the conversation today. It's been most enjoyable. Yeah, I would, you know, a plug for credit insurance, and all the other panelists just said the same thing. We're in uncertain times, it's how do you as an organization create resilience when you're in uncertainty times. A lot of companies take the old-fashioned methods. They start to adjust their operational costs. They don't spend, they don't invest, they don't open new op branches. So that's a natural reaction to uncertainty, and what credit insurance is can create some resilience in your business model and allow you to maybe open that branch in Latin America, or take a little bit more credit risk on a buyer that you're full up on, or credit insurance advisors are telling you, please don't do that. Maybe you should think about reducing your exposure there. So that creates resilience in your business model, and we know for sure that what's in front of us is not what we're predicting today. Is in 3 or 4 months' time, it's going to be completely a different agenda, because we know that whatever they're going to call it, Max, I don't know what they're calling it now. They've got everything. Is it called the reconciliation now of the American economy? So it's just going to be a fascinating journey. But as it's uncertain, please reach out to your credit insurance broker or your underwriter and start a conversation, because we're more than happy to engage and help you in the right direction during these times.
Yeah, we can certainly help manage through these risks in uncertain times, for sure. I want to thank the panelists. I want to thank, James, Max, Antoine, and Serena for a really engaging discussion. And I also want to thank Tinubu and Trade Finance Global for giving us the opportunity to have this discussion on the platform.
Thank you, Harp, for guiding us through the discussion.
Yes, thank you so
Thank
much.
you, Africa.
Thank you.
Thank you so much.
Thank you very much.
Bye-bye.
Bye.
So thank you very much, Harpreet, James, Serena, Maximilian, Antoine, for that overview. It's nice to hear the US mentioned in a positive tone for once in the last week. You've heard about the market opportunity, the growth potential, and the positive prospects for credit insurance in the US. I think it's definitely something that many people listening in on this conference can take away. And what a way to round off an invigorating day. So to close, I'd now like to hand over to Tinubu's CEO, Morgan Frank, to offer some summarizing remarks. Morgan, over to you.
Thank you very much. I agree with you. I mean, I hope everyone has been as energized as I've been. I mean, it has been amazing discussions. So I would certainly like to start by thanking our dear panelists for the discussions, the insights, the energy they put into all the different topics we discussed today, the 4 topics. I would like to thank all the attendees that attended this 2025 Tinubu Trade Credit Conference. As I said, Tinubu is celebrating this year our 25th anniversary. So 25 years of partnering with this industry, 25 years of massively investing in our software through relentless learning with our customers, with our partners, with many of you who have attended today. We're very proud that with our functionally rich solution, highly flexible solution, we're helping new entrants in this market. And this was, the first panel today. That, to take the words of Richard Wolff, who has finished the panel on supply chain transparency, we help enhance the transparency and digitization that is much needed in the trade world, and certainly in the trade credit industry. AI is a topic that obviously we're very keen on. I mean, it's a very high technology topic for us. So it's one that we believe we can really advance and accelerate the program of any of our customers and partner in this industry. And last but not least, I mean, we heard a lot about uncertain times. As a strong and reliable partner to this industry, we can help this industry navigate those times. But we talked a lot about data, technology, and those are 2 key pillars of any digitization effort, digital transformation. There is one topic, a key enabler that obviously I'm sure is at the central to all of us in our strategy, which is the talent component. And maybe I'm opening up for what could be a topic as the next digital conference, but talents are very important. It's important as we think of reducing the administrative burden to focus them on a highly valued task. It's important to create seamless and modern environment with a modern user experience, a modern user interface, to give easy access to well-structured data. All of these are critical enablers to attract and retain the talents that, in face of uncertainty, with the challenges, but also with all the opportunities that we can seize as an industry, we need those talents. And at Tinubu, we take it very seriously, and we believe that we can help you attract and engage those underwriting as well as technology talents, to engage them, but also to equip them to do what they do best, that is driving innovation, do their underwriting perfectly. And so this is, again, I believe, a key topic for us as an industry. So I will leave it there and we'll hand it back to Dipesh, but it has been a great day. We are at Tinubu thrilled to be part of this industry. As we saw it, we're a community. Antoine mentioned it, it's competition. At the end of the day, we're all in the same industry. We're all eager to expand it. And so that's why I personally, and again, the whole Tinubu team, look forward to keeping on engaging with all of you in the next few days, in the next few weeks, to keep this industry growing. But thank you very much again, Dipesh, for the organization and to the two TFG team. But now I'm handing it over to you and looking forward to our next one. Thank you very much, all of you.
Thank you, Morgan. And look, for me, this conference has been a bit of a sweet relief from the barrage of news. Think about it. When was the last time you saw a news story that was actually positive and uplifting? But in trade credit insurance, the story is not all doom and gloom. This is an industry where innovation has to be encouraged and should be celebrated rather than just one stuck in antiquity. I want to sincerely thank Tinubu for hosting this fantastic conference day. It's been a blast. I'm Dipesh Patel, editor at Trade Finance Global, signing off for the Tinubu Conference Day 2025. Thank you so much to all of our great panelists, our great speakers, and most importantly, to you all for listening in and tuning in throughout the day. Thank you very much.